It's on paper, it no longer belongs to the parents. That's kind of what we want when we're talking about Medicaid and other benefit planning. Hi, Jeff Marsace, the Plain English Attorney, and this is a client-requested video, and we're going to talk about the 5 things you really should expect if you're going to be the trustee of an irrevocable family trust when someone is doing Medicaid or other benefit planning. All right, so here are the 5 big things that you really need to understand if you're taking on this role. The first is, look, it's a big responsibility. I'm going to use the term parent or parents and the trustee, who's typically one of the children. They're going to be holding on to all of this money and all of these assets for the parents. So typically we're setting up the Irrevocable Family Trust. The parents are putting money into the trust. And at that moment, that money is kind of out of their control, and it has to be looked at 2 ways at the same time that are a little bit contradictory. When it comes to Medicaid and legally, it's no longer the parent's money. That's the way it is. Either it went as a direct transfer in, or we did some things to filter it through to avoid the 5-year look-back period on that money, or it's a combination of the 2. It's on paper, it no longer belongs to the parents. That's kind of what we want when we're talking about Medicaid and other benefit planning. At the same time, the trustee knows and understands, okay, this is the parent's money. I'm not going to take it and spend it on me. This is why in a lot of cases, choosing the trustee becomes a really big deal. So if you're being chosen, it means they've put a lot of faith and trust in you. All right. Second thing to be aware of is this is kind of a 2-phase beneficiary thing in the trust. While the parent or parents are alive, as long as at least one of them is alive, and that's really the intended beneficiary, even though they're not within the trust, the beneficiary, you have to look at it as if it's your money as the trustee, again, in trust for the parents, but on paper it's not. But upon the parent's death, that's it. The terms of the trust incorporate all of the estate planning wishes in terms of dividing the assets among the beneficiaries. So it's very common, let's say they have 3 kids, and they'll list one child as the first trustee, another as the second successor trustee, and then a final backup as a third successor trustee, and it's the 3 kids just in an order that they've chosen. The first trustee is managing the assets through the parent's lifetime, applying for benefits and handling things for them. But they're taking money out, putting it into a filter account, getting it out to the parents, or paying for things for the parents. But then the moment they are both passed on, the other terms, the estate terms, kick in the trust, and they can't look at it as theirs anymore. At that point, they have a fiduciary responsibility to the other beneficiaries to handle everything and divide it the way the trust says. So there's that switch from, yeah, really I can use this however I see fit, and then going to, oh no, I have to do this exactly the way the parents laid it out in terms of who gets what and when and all that other stuff as beneficiaries after they've passed on. So yeah, you're going to have to shift gears there. Whenever you're trying to get money from the trust to the parent or parents, or you're paying for something for the parent or parents, you have to do this as a 2-step process. Again, and this is very important because Medicaid looks for these things. You can't ever write a check from the trust to your parents. You can't ever write a check from the trust to pay for something for the parents. You have to write a check or transfer money into a personal account for the trustee, and then the trustee out of that personal account is kind of saying, you know what? I'm going to use this money that I just took out of the trust that I'm allowed to put into my account, and I'm going to pay for this thing for the parent or parents. Okay, so there's no way to really tie that trust money directly to the parents, so you have to do these two-step transactions. All right. The other question that always comes up is, wait a minute, how are these trusts taxed? Now, I do have a previous video, and we're going to put a link in the description that goes over taxation for these trusts, but let me give this to you. You do have to handle the taxes each year, and there has to be a 1041 trust tax return for the Irrevocable Family Trust, because there's potentially money being gained. There's income, dividends, interest, capital gains, whatever. There's a taxation element to it. Now, this can be handled one of two ways. The first way, which most of the time ends up being more expensive than it needs to be, is to file the 1041 tax return and put all of those incomes and gains and whatever on the 1041 and then pay it at the trust tax rate. The fact is, trust tax rates tend to be higher than individual rates in most of the cases. So that ends up meaning you're paying more money in taxes than you have to. All right, well, what's the alternative? And this is the one that most of my clients look at and talk about with their accountants. They'll file the 1041 trust tax return. It's going to have zero interest and gains because the trust is going to do 1099s and K1s and whatever else to have the income attributed to the trustee. Well, how does that happen? Well, wait, look at this trust. While at least one of the parents is alive, the trustee is in charge of the trust. They're the trustee. And they're listed as the beneficiary of the trust as long as they are still serving as a trustee. So it's money in their pockets that they can take anytime they want. So it's entirely appropriate for that income and interest and gains and whatever to go on their 1040 tax return. And in this, I'm talking about state equivalents too. So all of that can be attributed to the trustee. Will that make their taxes go up? Yeah, it will. But usually not as much as if you paid those taxes directly on the 1041. So overall, you're coming out ahead. Well, does the trustee have to come out of their own pocket to pay those taxes? Well, technically, yeah, but then they can take an equivalent amount out from the trust and put into their own pocket. So in the end, you're saving money on taxes by having it go on your 1040. Your taxes will go up, but then you can calculate what that difference is and just take the extra money out. So it ends up not being necessarily a wash. The family comes out ahead. And that's really what we're talking about here. All right, so what about transactions? What should you expect in terms of transactions and the number of them? In a lot of cases, it's not a ton of transactions that happen. In a lot of cases, when my clients are setting all of this stuff up, we're getting ready to start the 5-year clock for Medicaid or filtering money through. At that point, the parents are kind of really minimizing everything. So usually it's down to just one checking account that they have. That's where their pensions and Social Security and other stuff comes in. That's where usually their monthly bills are going out. And so they'll keep anywhere from maybe a $5,000 to $20,000 balance in that checking account, with the money coming in almost equaling what's going out each month. So there's nothing that needs to come from the trust, filter out to the trustee, and go over to them on a regular basis. Well, what if there is? What if we haven't gotten all the way through that 5-year look-back period and there's home health aides? Well, okay, the trustee can almost set up automatic transfers from the trust to that filter account, and from the filter account to pay the bills for home health care, or to the parent's checking account to pay for home health care, although it's probably more efficient to just pay for that home health care out of that filter account. Just set it up automatically, so that you usually end up with maybe several transactions a year where mom or dad have spent the money that they're keeping in their checking account down to the point where they want to replenish it and bring it back up to that anywhere from $5,000 to $20,000 level. So there usually aren't a ton of transactions. And if there are more transactions, at least on a monthly basis, it's something that's automatically can be set up to move money online. So it's not necessarily a big burden on the trustee. But again, it has to be handled the right way. All right, so those are the 5 big things. Now I'm going to put out there a 6th thing, but it's probably better to do with a separate video. That 6th thing is, all right, how are you going to manage the assets and invest the assets in the Irrevocable Family Trust? Because it does matter. I'm just going to throw this out there. You don't want to have mom or dad transfer $500,000 into the trust, start the 5-year look-back period, the money goes into the stock market, and then suddenly the market crashes and it's at half the level they put the money in. So now there's only $250,000 and they need long-term care sooner. The penalty is on the $500,000 that went in. Medicaid doesn't care how badly the investments were made within the trust after that transfer. So you almost want to look for something that's safe, guaranteed not to lose money, insured. You're not going to lose money, even if you may not gain as much on the upside during that 5-year period. I've said enough on that. Again, separate video. All right, so I hope you found that information useful. If you did, please go ahead and click like, subscribe to the channel if you want to keep getting this good information. And as I always say at the end of these videos, stay safe, plan ahead, and enjoy life. And whatever you do, make it a great day.